After studying this module, you shall be able to learn about the growth and performance of mutual funds in India, know about the evolution and contribution in the form of associates and promotional institutions to the industrial sector of economy by the UTI. Understand about various products offered by UTI and evaluate the difference between the public and private mutual funds in India. We will commence our discussion by studying about the growth and performance of mutual funds in India. The concept of mutual funds in India started in the year 1964 with the setting up of Unit Trust of India, popularly known as the UTI. The growth and performance of mutual funds in India can be divided in 4 phases. Let us understand all these phases one by one. Phase 1 is from 1964 to 1987. During this phase, UTI enjoyed monopoly of being the only mutual fund in India. The first scheme launched by the UTI was US 64, which gained a lot of popularity. Later on, the UTI launched other schemes such as Unit Linked Insurance Plan, etc. Later on, UTI diversified its business in banking, securities trading, investor servicing, etc. by setting up associate companies. Now we will learn about phase 2, which is from the year 1987 to 1993. During this second phase, other players such as the State Bank of India, the Life Insurance Corporation, Canara Bank entered in the mutual fund market. This period experienced a lot of competition and improvement in terms of and conditions to the investors in mutual funds in India. Phase 3 was from 1993 to 1996. This third phase witnessed the increased competition in the mutual fund market with the entry of private sector and foreign mutual funds in the industry. Then SEBI came out with mutual funds regulations during this phase to ensure safety of investors' money and smooth functioning of the mutual funds industry in India. The fourth and the last phase is from the year 1996 onwards. During this fourth phase, SEBI felt the need for modifying the regulations issued in the year 1996. It circulated a consultative paper, Mutual Fund 2000, to make amendments. The content of the paper was deliberated among all the players in the mutual funds market, and a new set of SEBI regulations 1996 were released to bring private sector mutual funds at par with public sector mutual funds. Let us now focus on some facts. In the beginning, the UTI enjoyed the total monopoly in the mutual funds industry. Gradually, between 1987 and 1992, mutual funds were set up by nationalized banks and insurance companies. In the year 1992, the government allowed the setting up of mutual funds by private and joint sectors. In short, the industry has moved from a complete monopoly to that of a monopolistic competition. The investors' increasing interest in the mutual funds is because of the fact that while the investor is blessed with little or no knowledge about capital market, whereas the asset management company is equipped with economic and financial experts to manage the pooled resources. Also, a single small investor would not be able to invest his money wisely in diversified securities. around 60 to 70% of middle class households in India invest in mutual fund units. In India, there has been a gradual increase in the share of mutual funds. Since 1988-89, mutual funds gross savings of the household sector, the financial assets have increased from rupees 12.1 to 18 crores in 1980-81 to rupees 1,35,348 crores in the year 1994-95. The banking sector role has declined relatively. The most marketable growth was seen during 1980-81 to 1992-93 when units of the UTI increased from 0.3% of the total household savings in 1980-81 to 70% in 1992-93. However, this increase was slowed down later but is still growing. The amounts of deposits in banks are falling from previous years on proportionate basis. Investors now look mutual funds as an alternative option to put their savings into. Let us now understand the evolution and contribution in the form of associates and promotional institutions to the industrial growth of economy by the UTI. Mutual fund is an instrument for pooling the resources from various investors in small quantities by issuing units to the investors and investing the large amount of funds so formed by these small contributions in different kinds of securities and debentures in accordance with objectives as made known in offer documents. Here investments are made in diversified assets and securities of various sectors of industries. This diversification helps in reducing the risk of a particular investment. Investors of mutual funds are known as unit holders. The profits or losses are shared by investors in proportion to their investments. All mutual funds are regulated by SEBI. Now let us understand the working of a mutual fund. Working of a mutual fund begins with pooling of money to form a fund. Various investors pool their money to form a big fund. These funds are taken by asset management companies called as the AMC to manage funds according to various goals of the investor. These asset management companies employ financial experts and managers to understand the current scenario of market and invest the fund in most profitable sectors of the economy or society. There are also trustees of mutual funds who make sure that asset management companies are working in best interest of the investors and their money is safely invested. The asset management company pools money from small investors and invests it in various securities such as shares, stocks and fixed income investments. As everyone knows that it is not always possible that different securities of different sectors work well at the same time. So, an asset management company invests the pooled funds in different sectors such as steel, banking, real estate, entertainment, etc. Now, if a particular sector, say steel industries, are not giving good returns, but other sectors are doing well, then the average return of mutual fund investment remains stable. That is the task of financial experts of an asset management company to maintain an average rate of return. Investors in this way are saved from the fluctuations of stock markets and at the same time get an opportunity that even with a meager contribution they can get an opportunity to invest in share market and debt market. Investors get the benefit of growth in equity and stability of debts. Till now, it is clear how a mutual fund works, but the question arises what an investor gets as soon as it gives its money to an asset management company. They get units. Units represent the money invested in the fund. These units are redeemable to get back the money. These units have net asset value, that is NAV. NAV represents the value of one unit of investor's investment. Total number of units with investors multiplied by NAV gives market value of investors' holding. NAV is calculated after deducting all fund expenses and fee of AMC. Investments in mutual funds can be made in lump sum manner or in small amounts at some predetermined intervals. This makes them favorable for all kinds of investors such as salaried people, businessmen, etc. Every mutual fund has a set benchmark to measure its performance. It is based on Nifty or Sensex. These benchmarks are used to measure the performance of mutual fund. The fund manager's task is to analyze the market and cross the set benchmark of the fund. This is the reason for hiring funds managers. Let us now understand the UTI and mutual funds. The formation of Unit Trust of India marked the evolution of Indian mutual fund industry in the year 1963. The main objective of it was to attract the small investors. It was made possible through the collective efforts of the Government of India and the Reserve Bank of India. Eventually, many public sectors, private sector and foreign funds management companies entered the mutual fund market. In November 1987, SBI Mutual Fund from the State Bank of India became the first non-UTI mutual fund in India. The Unit Trust of India is one of the leading mutual fund service providers in India. It is commonly known as UTI Mutual Fund all over India. It is managed by UTI Asset Management Company Private Limited, which was established on January 14, 2003. UTI Asset Management Company Private Limited has been formed by the UTI Trustee Company Private Limited for dealing with various schemes developed by UTI Mutual Fund. UTI Asset Management Company Private Limited is located in Mumbai in India. This will correspond with the provisions of Investment Management Agreement, the Trustee, the SEBI mutual funds regulations and the objectives that are being assumed by various schemes. Unit Trust of India came into effect from 1st February 2003. The UTI Mutual Fund offers schemes for the need of various investors. The Unit Trust of India has 70 UTI financial centers and UTI international offices in Dubai, London and Bahrain. The establishment of UTI actually harbingers the scheme of mutual funds in India. We shall now discuss the various products offered by the UTI. UTI being the pioneer of mutual funds in India, after various schemes to suit the requirements of the various categories of investors, it keeps in mind the risk-taking ability of an investor and offers them with a suitable scheme. Some of the schemes offered by UTI are as follows. Number 1. Equity funds. In this option of equity funds, the funds are invested in stock of various companies. Here, benefits for unit holders are secured by capital appreciation. Funds are invested in equity shares and convertible and non-convertible bonds. This product is beneficial for those investors who want long-term capital growth and are ready to take high risk. Second, theme-based mutual funds. Contra dividend yield, global, lifestyle, value, etc. are some of the popular themes that the mutual fund industry has played with. The objective of theme-based fund is to give best returns by investing the pooled funds in those stocks which are in agreement with a particular theme. So these investments can be in multi-sectors, international stocks, commodity market, etc. Third, sector funds. A sector fund is a mutual fund exchange traded fund that concentrates its investments in a single sector of the market. These funds are focused on stocks within a certain business or industry. They are more volatile than the stock markets. The different sectors may be technology, financials, communications, utilities, natural resources, healthcare, real estate, precious metals, etc. The next is tax planning funds. These funds satisfy the tax saving needs of the investor. They are usually close-ended schemes with some lockup period in them. These funds are related to portfolios that include those securities that make the maximum benefit of tax exemption under Section 80C of the Income Tax Act. Let us now consider the arbitrage funds. Mutual funds are those funds that are made up of such schemes that take the maximum advantage and benefit of arbitrage opportunities current and the future markets. The next are gift funds. In these funds, money is merely invested in securities that are usually risk-free. NAVs of these schemes also fluctuate due to change in interest rate and other economic factors, as in the case with income or debt-oriented schemes. The next we would discuss are the index funds. The index funds replicate the portfolio of a particular index such as the BSE, Sensitive Index, S&P NSE, 50 Index Nifty, etc. These schemes invest in the securities in the same weightage comprising of an index. NAVs of such schemes would rise or fall in accordance with the rise or fall in the index, though not exactly by the same percentage. The next are segment-focused funds. These funds focus on a particular need segment such as retirement benefit, children career, etc. These funds retain the flexibility to invest in entire range of equity, debt and money market instruments. Now we will consider the monthly income plan. The monthly income plan of mutual fund is a debt-oriented scheme that generally 75 to 80% funds in debt instruments and the remaining in equity instruments. MIPs aim to provide investors with regular money. They are basically taken by passive investors. In short, there are more schemes offered by UTI for their investors. In fact, they keep on developing new schemes according to the requirements. Above mentioned schemes are some of the currently offered schemes or plans. Let us now throw some light on the difference between public and private mutual funds in India. A mutual fund is an investment instrument which takes funds from many different kinds of investors to invest in stocks, bonds, money market instruments, and other financial assets. Mutual funds can be either public or private. Both types of mutual funds have their own intricacies and benefits. Let us now consider public mutual funds. Public mutual funds, as their name suggests, are open to public to invest in. They are managed by professional funds managers who actively invest in various securities to achieve mutual fund stated objectives, which could be capital growth of income. We will now discuss private mutual funds. Private mutual funds are an exclusive investment with a limited number of investors. The minimal investment for a share of a private mutual fund is much higher than that of a public mutual fund. Depending upon the number of investors in a private mutual fund, there is a little or no government regulations. We will now consider the points of difference. Number 1. Public mutual funds are open to public, whereas in private mutual funds, only few investors can participate. 2. Comparatively, there is less governmental regulation in private mutual funds than public mutual funds. 3. Public funds are prone to a greater investment risk than public mutual funds. Fourth and lastly, public mutual funds comparatively cater larger number of investors than private mutual funds. In general, it has been seen that investors feel safer with public mutual funds than private mutual funds. We shall now recapitulate what we have learned so far. Mutual funds are therefore great instruments of investing for those investors who have little money to invest and also little knowledge of finance. These funds help the investors to park their money in a professional manner by seeking advice of experts from asset management company. The growth of mutual funds can be seen from increasing number of investors in this sector. Mutual funds are a great means of investing for investors of different needs. There are various kinds of schemes and plans that are offered by mutual fund companies for the benefit of investors.